Retirement. Unless you are involved in an accident or illness strikes, there is a good chance you will grow old. Will the private company still be there when you retire? Planning how much to invest. State pension paid out at 65 for the moment. Work till 95, that's a way to make a living. Isn't that what Dolly Parton sung? You receive basic state pension based on national insurance contributions. It rises with inflation. State earnings related pension scheme. Employer pays into this while we work for them. Stakeholder pension. You can invest in this scheme yourself. Specialist companies handle investments of funds on stocks and bonds for a fee that can only be used to provide money for a pension, not invested elsewhere. Be aware, the more you save up for the future, the more you will have to pay for your care home when you get old or ill. They could even sell your house to pay. Is it really worth it? Company pension. An amount of money is taken out of your wages. It is invested in stocks and bonds. The end result is paid out when you retire, or paid to spouse if you die while working. If you leave an employer, you can freeze the scheme and start a new one with a new employer. The investment stays with the first employer and continues growing, or what you have earned so far is handed to you to invest elsewhere. Keep notes of all schemes, or you will forget that you are owed money when you retire. If you move, the investment fund company will never find you 20 or 30 years later. Miss Smith will be hard to trace when she becomes Mrs. Jones, or Miss Hisbits had the sex change. Companies can pay a sort of insurance to the government in case they get into financial difficulties and don't have enough money to pay out the pensions. If a company has 5 or more full-time employees, then it must offer a scheme. On retirement, you could get a large sum of money. Of this, you can take 50% to spend as you wish. The rest must be put into an annuity to provide the pension each month. You can choose your own saving scheme instead, but if you get it wrong, it is your fault now. An annuity is a fixed amount paid out each year till death. An investment company decides how much it will pay out. Great if you live a long time, but if you die shortly after retirement, they keep what is remaining in the fund. You can pay extra, so some money will go to your wife or husband. Shared life guarantee level or linked non-state pension can be taken from age 55. Divorced or single couples may not get all the money expected. Read the small print. Private pension plan is similar to company plan, except you pay in and administrate it yourself. It could cost more. Your money is invested in an annuity, which is a low interest investment that hopefully builds up until the date you retire. Then the money is invested into another fund which hopefully will pay out a monthly income as a pension to top up the state pension. In years to come, means testing might say, as you have a private pension, there is no need to give you a state pension. At present, government gives tax allowances to encourage people to take on private pensions. Defined benefit pays out set percentage of final salary or average of last working years. They must make up for shortfall if the investment is not a good enough return. Defined contributions gives no guarantees. Being in the scheme may give you tax break where you don't pay as much tax. Others can pay into scheme for you. Group pension scheme. Similar to above, but the boss does not have responsibility for administration. Moving jobs will reduce pension rate. You can leave money earned in a scheme and collect it when you retire. If the firm is still there, you can transfer it to a new scheme. Rates will be different. If in a scheme for less than 2 years, you could claim your contributions back to deal with as you please. What you get depends on how well the investments have done. You will get an annual statement. The employer could pay additional voluntary contributions, or you can pay free-standing additional contributions privately. Stakeholder pension has low charges and does not cost anything to move out of the scheme. It can have a defined plan and standard contract. The state pension is paid from national insurance. It is like a pyramid selling scheme. The last people in pay the first people in and hope there will be others to pay them when they retire. With the increasing use of computers, robots, and the movement of jobs to cheaper foreign countries, working people are going down, so the government is pushing for extra private pensions to cover future shortfalls. The amount of pension you get is dependent on what you have put in. This is decided by what is called qualifying years. Each qualifying year gives you so much pension. A qualifying year is made up of 52 weekly national insurance contributions. If you have not paid full year's contributions and fear a smaller pension as a result, you can pay the year's missing contributions voluntarily to make up the shortfall. If you live abroad at pension age, you can have your pension paid into your local bank sometimes. Exchange rates alter your money. If you have not paid enough national insurance, you will be paid a basic pension. This is called Pension Credit Minimum Income Guarantee Scheme. If you are in the position that you will only receive a small pension, cut down on your spending in the years before retirement. Get used to less money so it is not a shock. Also invest in some solid furniture and objects that will see you through your remaining years. National insurance allows you to get job seekers allowance, sick money, maternity allowance, state and widow's pension. Payroll departments get charts, etc. from government to work out figures, charged at different rates. Class 1 is paid by a mix from employer and employee. Class 1A is charged to people who get extra payment such as company car, fuel allowance and accommodation. Class 1B is an employer scheme. Class 2 is a self-employed person scheme. Class 3 is voluntary to make up for unpaid periods. Class 4 is for self-employed paid on profits. You can get time allowed in place of national insurance contributions if you are in a position where you are unable to work. Reasons could be such as looking after children or sick relatives, etc. You can pay less national insurance by going into an employee's pension scheme, but you may not get all the benefits normally given. This is known as contracting out. If a wife is older than her husband, she gets 100% pension until he reaches pension age. Then her pension drops to 60% and he gets the 100%. If the husband receives a pension, his wife will receive a pension, even if she has not paid national insurance herself. Women who pay a reduced rate national insurance will not receive a pension unless they stop paying a reduced rate and pay Class 3 instead. Look into prepayment funerals. Pay now, die later. Pay today, then on death your funeral takes place. Saves the problem of if the bill is not paid by a set date, then up you come. Could the company go out of business before you die?